What if I told you that adding a losing asset to your portfolio could make you more money? Sounds insane. But this is exactly what modern portfolio theory proves, and it's the reason every hedge fund on Wall Street obsesses over one number above all others: correlation. Welcome to Quantify. Today we're breaking down the math behind portfolio diversification, not the hand-wavy don't put all your eggs in one basket version, but the actual formula quants use to build multi-billion-dollar portfolios. By the end of this video, you'll understand why two stocks with identical returns can produce completely different portfolio outcomes depending on how they move together. The portfolio variance formula has three parts. The first two terms, shown in blue, capture each asset's individual risk weighted by allocation. Those are fixed once you choose your positions. The critical third part is the cross-term in teal and gold, 2 times the weights times the individual volatilities times rho. When rho is high, this term inflates total portfolio risk. When rho is low or negative, this term shrinks it. That single number rho determines whether diversification actually works. Correlation runs from -1 to +1. When rho is +1, assets move in perfect lockstep, you get no diversification benefit whatsoever. When rho is 0, the cross-term vanishes and you get the maximum free diversification. When rho is -1, assets move in exact opposition, you can actually eliminate risk entirely with the right weights. Here is the counterintuitive part. Suppose asset A returns 8% with 20% volatility, a Sharpe ratio of 0.40. Asset B returns only 4% with 15% volatility, a Sharpe of 0.27. By every standalone metric, asset B is clearly inferior. It has lower return and lower Sharpe. A naive investor throws it out immediately. But if asset A and asset B have a correlation of -0.5, combining them 50-50 produces a portfolio returning 6% with only 9% volatility. That is lower than asset B's 15% and dramatically lower than asset A's 20%. The Sharpe ratio jumps to 0.67, nearly double asset A's standalone number. The weak asset earned its place through negative correlation. Look at this bar chart. Asset A carries 20% volatility. Asset B 15%. The combined portfolio at -0.5 correlation carries only 9% volatility, less than half of asset A and well below asset B. This is the free lunch of diversification. You are not just averaging the risks, you are canceling them. Watch what happens as we slide correlation from +1 down to -1. At +1 perfect lockstep, the portfolio carries 17.5% volatility, which is just the weighted average of the two assets. As correlation falls, the variance shrinks. At 0, we hit 12.5%. At -0.5, 9% below both individual assets. And at -1, you could construct a portfolio with near zero volatility. This is the mathematical proof of diversification. Now scale this up. In a portfolio of n assets, the covariance matrix sigma is an n by n grid of all pairwise correlations and variances. Portfolio variance becomes W transpose sigma W, where W is your weight vector. The diagonal holds each asset's own variance. Every off-diagonal entry is a cross-term controlled by correlation. This one equation is the foundation of every optimizer from Markowitz's 1952 paper to the $500 billion quant funds running today. But here is the critical trap. Correlation is not stable. In normal markets, correlations between different asset classes run from 0.2 to 0.45, shown in teal. But in a crisis, 2008, March 2020, correlations spiked toward 0.9 and above, shown in red. Everything sells off together. The diversification you relied on disappears exactly when you need it most. This is called correlation breakdown, and it is one of the hardest problems in risk management. Solutions include stress testing with crisis period correlations, and adding assets with structurally negative correlation like volatility products and tail hedges. Your action item: next time you build a portfolio, don't just look at expected returns. Pull the correlation matrix. Identify your most correlated pairs, those are your concentration risk. Then ask, what can I add that lowers those correlations? That question is worth more than chasing the next hot asset. If this clicked for you, hit subscribe. Next episode we go even deeper, the efficient frontier, and why there's mathematically an optimal portfolio for every level of risk. Drop a comment if you want me to build this in Python live. That's Quantifeia, where the math is real and the edge is yours. See you next episode.